Hello, everybody.
Hey
Welcome
guys.
back. Welcome back to another live stream episode on the Bravos Research channel. Got lots of feedback from the live stream we did on Wednesday. So we're going to be adapting a few things and answering some of the questions that you guys had in the last live stream. We're going to talk about the title of this video that's going to be the AI bubble that's unwinding, it's imploding right now. Um, Tech stocks have been down quite significantly. Semiconductor stocks have been underperforming significantly. Nvidia breaking down quite aggressively. So we're going to talk about that and how much more pain we should expect, what our strategy is regarding that, what are the trades that we're looking out, and generally how we're approaching this unwind on our own trades. So um, we'll also, as I mentioned, sprinkle in some answers to questions that we saw in the last live stream. So first of all, we saw some comments regarding me not being an AI voice. So yeah, I am indeed a real person. Here I am. So it's great to see that you guys are appreciating that we're putting a face on these videos, on this content. And yeah, uh, I, I don't think this will be the last live stream that we do. So there's more to come on this. Um, so yeah, the other first big question that I saw on the last live stream was, why don't we just launch our hedge fund? And I'll try to give the most straightforward answer that I can regarding this. First of all, we could, and that might be something that we actually do in the future. Um, we certainly have what it takes. We have traders that outperform the market, that beat the market on a consistent basis. We have capital, so we could raise enough funds to launch a fund tomorrow. Um, so the combination of these things is there, and that's all you essentially need to launch a fund. But the reason we don't do it is the headache of having a hedge fund. So it's compliance, it's regulations, right? When you put on a trade, or when you remove a trade, you have calls from your clients asking what's going on. It's also a very different type of trading style. So we have a trading style that's very quite aggressive, right? We're looking for higher returns, and so we're willing to risk a lot more. We're willing to be on bets that are more volatile. We're also willing to go, for example, 100% cash if we believe that the market is vulnerable. That's not something that you can do with a hedge fund. The goal of a hedge fund is to attract large pools of capital, large investors, and these large investors are not looking for extremely high returns. They're looking to preserve their wealth, right? They're looking to have as little drawdowns as possible, with zero risk. So steady returns with zero volatility, zero risk, and that's not our thing. So we could do a hedge fund with our type of high return, high risk strategy, but there's also the psychological element of managing people's money. So what we do on the website is sending out trades, sending out our opinion on the market, and that's already a big psychological weight of actually doing that, and actually having people pay attention to what we're saying. Managing millions of dollars of other people's money is a whole different ball game, and it impacts how you make decisions. It impacts, of course, your day-to-day life and the weight that's on your shoulders regarding that. So the setup that we have right now, and it may change in the future. I don't want to close any doors, but the setup that we have right now gives us a lot more freedom, a lot more, as much room to do what we want to do from a trading standpoint as we want. We're also able to help a lot more people in the investment community by doing these types of things, by sharing our trades on our website, than we would if we had just a fund. And then also we make probably just as much, generate as much revenue as we would having a small fund. So we wouldn't be able to have a Ray Dalio type of fund anyway with our trading strategy that has that's quite again quite aggressive. So that's the first answer to that question that I think goes around a lot in the investment community, because people don't really understand what having a hedge fund actually represents. But that's our setup. And yes, if you want to be a part of this, of what we're doing, a trading membership, that's something that we would not have been able to do 10 years ago. Actually, showcasing our trades, showcasing our knowledge. You can go to our website, check out our service, check out our trading style. We're going to dive into some trades today, hopefully show you a little bit more about how we think about the market. We share each and every single trade that we take on our website, and there's currently an offer that we're doing, Black Friday offer. That's 40% discount on. I can't seem to scroll down to my. Let me share my. Yes. So just the trading membership is a 40% off for the Black Friday, something that we never do except on Black Friday. So you might get a chance to get this next year, but this is the cheapest price, and it comes down to $90 monthly, which is a democratic price for the value that we're getting, right? For the high performing trades, this is cheap. And we'll discuss later why we can't bring down the pricing to zero, not only because we want to get paid, but also because the people actually follow our trades, and that creates a lack of liquidity on the trades that we actually place. So this pricing is ultimately going to go up in the future as more people join the membership, because as more people join, there's less and less trades that we can actually take with the pool of capital that's participating in those trades. So we're going to get into that perhaps a little bit more into in the rest of this video. And by the way, this is a 40% discount on the membership, but there's a 55% discount on the bundle that also gives the education, because that's, yes, you can have the membership with the trades. That's great, but if you don't have the right mindset, if you don't have the right approach, if you don't know what you're doing, these trades might not be as useful as you think they are. So I do recommend that you take the curriculum, take the weekly training sessions as well, and that's the bundle of that is 55% off. So without further ado, let's get into the tech sector, the AI trade that I'm going to show you the chart that I put on the thumbnail, because I think that's a very interesting chart, is the XLK against the S&P 500 ratio. So this is the performance of the tech sector against the S&P 500. This is a chart that we've been watching for years now, and it's been slowly grinding up towards this huge level that was hit in 2000, right? It hit that 2000 level in March, and that was the peak of the dot-com bubble in 2000, and it led to a very rapid unwind of the tech sector. As you know, we're technical traders. We watch the price action. We watch these types of ratios, and having the market now, this ratio coming in to test that same level of resistance and rejecting off of it, it's telling us that there is selling pressure coming into the tech sector right here. Now, there's two options here. Either it leads to a small pullback, although, I think a lot of people are already feeling a lot of pain just from this small pullback, but Either it leads to a small rotational kind of pullback, a little bit like what we saw in 2024 or what we saw in 2020 and 2022, or it leads to a full, complete unwind of the tech sector that drops in a massive way as we have huge earnings contractions across the AI theme and across mega cap stocks as well that have been accumulating too much exposure and too much risk in regards to the AI theme. Now, I don't think we're in this scenario. Yes, this is painful. Yes, we're seeing selling pressure, but we do favor this to be a temporary correction. There might be more downside, and we're going to talk about our exact strategy in just a second. But I do favor a short-term correction. So before we actually dive into the specifics of these trades, let's talk about what is the AI trade, right? This is the tech sector, so it has everything, not necessarily just AI. And I think a lot of people are actually confused. What is the AI bubble? Everybody's talking about the AI bubble. But what actually is the AI bubble? It's not just NVIDIA. We really split that into three categories. There's the infrastructure aspect, which is the semiconductor stocks and data center stocks like Oracle. There's also certain stocks, I believe IBM and Cisco are also getting into that and seeing their earnings reflect that as well. So infrastructure spending, AI infrastructure spending, it's benefiting a lot from that, and it could continue to benefit it. If the AI bubble continues, it's going to continue benefiting, and this is really where the big trades are. And NVIDIA has already run up a lot, and there's other stocks that can run up just as much, right? So there's definitely big opportunities in infrastructure if this continues. But it's not the real AI bubble. Yes, it's benefiting from it, but these are not the companies that are actually driving AI, not necessarily driving the AI technology. The parts of the market that are really the innovators, and that's the second category, the innovators, is software companies like OpenAI, Anthropic, right? xAI, Palantir, even Tesla. Tesla is implementing AI, right? So a lot of people very excited about that. And these stocks have PE ratios. So Palantir and Tesla are the two real public companies that are in the AI innovation space. But these are companies that have over 400 PE ratios. So that is where you really see a bubble where you have expectations that are just completely absurd and that are never really going to be able to get met. That's why you have investors like Michael Burry placing a massive put options on a stock like Palantir that I believe he's betting on a 50% decline from current levels by 2027. So it's not he doesn't necessarily expect this to play out straight away, but he does believe that the valuations are so stretched that in the next year and a half or so, there's going to be at one point a large unwind on these stocks because of these extreme valuations. And so that's where the bubble is. In a lot of private companies like OpenAI, that's raising billions, hundreds of billions of dollars because of all the excitement around large language models. And so all of that is pulling capital from the third category, which is the mega cap stocks. So that's the third category, which is really a distraction from the other two, because this is stocks like Apple, Amazon, Meta, Alphabet that are investing massively into the AI sector just to satisfy investor demand, satisfy the FOMO that's happening in the tech sector around the AI theme. But really, this is just supercharging the other two sectors, right? It's supercharging the valuations of these real AI innovators, and that is creating a huge amount of demand for an AI infrastructure that's driving real earnings growth on the infrastructure theme. So semiconductors and infrastructure, it's not companies like during the tech bubble that had zero earnings. These are companies that are actually really growing their earnings, really selling more chips, selling more data centers, and seeing massive growth as a result of that. It's just that it's heavily tied to a part of the market that is way overvalued. So that's where there's a little bit of vulnerability. But in terms of exactly how all of this, when all of this is going to play out, and when all of this is going to unwind, it's a big bet here to be saying that tech stocks are just gonna collapse from here. So yeah, I don't know if you have something to add on that, Nick.
Yeah, so when you look at a name like Palantir, for instance, um, this is kind of where the disconnect between price and fundamentals really becomes obvious, right? Because Palantir has essentially doubled its revenue since 2023, which is fantastic, but the stock itself has moved over 2000% in that same period. Now, we're not naive to the fact that the markets themselves are forward looking, and a lot of this move is based on what investors expect Palantir to earn years from now, not necessarily what it's earning today. But once you start baking in these PE ratios of 2, 3, 400%, the levels of growth that are required to justify those valuations become so extreme that the reward isn't really worth the risk anymore, especially from maybe like an investor's point of view. And these are the kinds of stocks that can drop, 50 to 60% if even a small part of those expectations don't really get met. So it's not that there's no opportunities in stocks with these extreme valuations, especially from a trader's perspective, but you have to understand that the risk for that is dramatically higher, and you need to size and manage those positions very differently than you would just a typical growth stock.
Yeah, yeah, absolutely. And by the way, that's those valuations, those extreme valuations, are mostly on those AI innovation names, right? And when you look at the semiconductor sector, yes, it's expensive for sure. Um, it's I believe the average PE ratio is 40 or 50 or something along those lines. But there's room for it to get more expensive, and this is a part of the market that's growing its earnings faster than any other part of the market. So there's a real fundamental tailwind behind the semiconductor sector as a result of the AI theme. And so this is the part of the market that's very interesting if this continues. And that's the big if. We're not yet in a rush to get back into this, but if this continues, this is a part of the market that we want to participate in as traders. We had many trades on semiconductor stocks in this rally in 2025. We were trading um, ASML, Applied Materials, ACMR, KLAC. We're going to take a look at some of these later. But we had some very successful trades on semis. Now, and you can see, we were used to seeing semis generally breaking out through levels again and again, right? Break out above this trend line resistance, break out above this basing pattern. I'm just uh, sketching this very quickly. Break out here, very nice. And then something happened right here that started to look like a shift in character, right? Semiconductor ETF broke out, yes, in late October. That was nice, and then false breakout, right? So this is a first warning sign of a weakness from the price action, right? And this is where we actually completely exited all of our positions, right? ASML, we had exited ACMR a little bit earlier, but ASML and Applied Materials, we exited right here. Um, and sure enough, further downside, and now Yesterday, at least, we had a full breakdown below topping pattern here, a uh, head and shoulder type of topping pattern. So we have yet another breakdown below technical support. So we big change in character, right? Going from breakouts to false breakdown, right? So that's the type of shift in character that we really want to pay attention to. We don't want to fight, and until we have a real improvement in this structure, we're going to be just sitting on the sidelines, watching patiently what happens to the semiconductor sector. Um, this is not a huge topping pattern, right? It's not a huge breakdown. This is quite different to, for example, the breakdown that we had right here. That was a little bit more concerning because of the size of that pattern that you had in between, that developed between February 24 all the way till February 25, a year-long topping pattern that broke down right here and led to a 30% correction from that break. So here, even if this pattern plays out completely, the measured target of these types of pattern is roughly the size of the head, right? And you take that from the break, that gives you a broad sense of what kind of move you should expect. That could be as much as a 10% correction from the break, taking us to around $300 on SMH. This is not a prediction, but it's an indication of what are the potential scenarios here. And it's very important to have that mindset. This is something that I've learned the hard way many times before in my trading. Is, just because you have a pattern breaking down, it doesn't guarantee that the pattern is going to play out. Doesn't guarantee that you're not going to see a false breakdown. Doesn't guarantee that the measured target's going to play out. And the truth is, you don't need to have that guarantee in order to actually profit, right? All you need is flexibility and be able to quickly adjust your positioning based on any new information that you might have. But overall, right, and again, speaks to the change in character that we have, the different character that we have right here, which is why, just from a technical price action standpoint, we're not expecting this to be a huge correction in tech stocks, and on the semiconductor sector. Look at the moving averages. Very strong upwards trend. Very different to, for example, what you had right here when the semiconductor sector broke down. Right there, moving averages were curling downwards, indicating that you were really seeing a broader shift in momentum. Here, this looks a lot more like maybe what you had right here, and that was ultimately an opportunity to buy the dip. Not necessarily straight away, but you were very well off if you were watching for a consolidation and a buy opportunity on the breakout, and that's kind of our mindset right now. It's this is a short-term correction. We're watching some key overhead resistance, and if we see enough evidence that this correction has run its course and that it's resuming higher, we'll be adding some names in the semiconductor sector, because this is, again, probably a sector that's going to outperform if it continues higher, because of the fundamental driving force behind this AI theme.
Exactly. And just to add to that, just to reiterate kind of what you're saying, our trading style isn't built around trying to front run these moves. We're not in the business of trying to guess the bottoms or the tops. What he's alluding to is, like, our process requires confirmation. We want to be seeing price breaking out above those key resistance levels. We want to see the relative strength showing up, and we want to see some structure that allows us to capture the meat of the move, not necessarily the first dollar or the last dollar, but the highest probability part of that move. And we get it that it's appealing to get the absolute best price and try to call the bottom, especially when we are referring to things like the macro backdrop, which looks constructive. But the reality is you simply don't know. And even in a good macro environment, if your price action isn't constructive, then there's really no high quality trade to take. So as we've said before, that the price is king, and the charts are going to tell you when demand is actually stepping in. And
Mm.
having like the fundamentals and the macro um, pointing in a good direction is giving us great context and tailwinds and kind of telling us where we want to be involved. But until that price action works in your favor, that's what ultimately decides as a trader when we're pressing that button.
Yeah, yeah, absolutely. And by the way, the right now, yes, maybe this is the beginning of something, right? Who knows? The SMH is bouncing off of the 100-day moving average, which is relevant support. There's definitely demand coming in, but again, I would say until we were able to kind of not only pop back above that broken support level here, there's also some horizontal support at horizontal resistance at $333 on SMH. Until we're able to pop back above that, and even then pop back above this trend line, our bias is still to the downside. Our bias is still cautious, and yes, we do still have a short trade on the S&P 500 right now. So that's what we're reading from this price action. That being said, again, let's take a look at some specific trades here, including ASML. That's a trade that we had sent out an alert on right here as it was breaking out above this kind of basing pattern right there. And ASML looked very, very strong from a fundamental standpoint as it was resuming out of this this basing pattern. Won't get into the details of that, but that's something that we included in the alert that we sent out. We took out the position, as I mentioned, when we started to see some weakness in the semiconductor sector around early November, I believe. And since then, it's just been consolidating. And so far, it's actually looking quite strong, right? It's holding above this price channel support, right? That has quite a few key reactions. So we want that to hold. And overall, if you zoom out, let's remove these levels and put the um, moving averages. You are in a very, very strong structure on ASML, and this is again a semiconductor equipment company that if this AI theme continues, you're going to have more demand for semiconductor equipment. And can it break out to new all-time highs? Absolutely. This is a company that has grown its earnings substantially since September 2021. Of course, it was highly overvalued back then, but then again, the market's getting more and more overvalued today, and yet this stock is actually not that much higher than it was back then, despite having grown its earnings quite a lot since. But so this is one of the things that's on our radar. That could be able to actually resume higher when conditions change for the semiconductor stock, and potentially have a lot more upside. Applied Materials as well is another one, very similar type of structure, also basing pattern right here. You'll notice our trading style is very consistent. We don't want any big surprises. We initiated that trade on Applied Materials right here in late September. We wrote it for a big move up as we saw the um, price action begin to wane, and momentum begin to wane. We took out that position, right? And this is one of the things that we highlight in the curriculum, is how we manage positions. Something that will be an episode that's not yet filmed that we'll be sending out in the next couple months. But it's how we manage these trades, how we manage the profit taking of these types of positions. So yeah, AMD, another one, very, very interesting technical posture. Unfortunately, we were not able to catch the AMD trade here because it gapped up overnight. It was as a result of a partnership with OpenAI, and AMD has retraced in this recent correction, very violent retracement, right? For those of you, for some people that may have bought into the euphoria and bought this breakout, big reversal as the tech sector actually weakened. But overall, you can see AMD is looking very strong. Big basing zone that has just been broken out, and it's retesting that right now. So when the tech sector begins to roll back up and begins showing signs of breaking out, we'll be looking to participate in that. In the short term, however, is this something that we're looking to buy and try and catch the falling knife on? Not really. We're very happy sitting on the sidelines and seeing how this plays out, and if these key levels like this on AMD, like the 185 support level holds on AMD, that would be very important to hold for short-term structure on AMD. If it breaks through that, it doesn't look nearly as good. So yeah, I don't know if you had something to add on this, Nick.
No, I mean, I think you said it perfectly. For a chart like that, where you are showing a breakout and constructive longer term price action, and the stock is retracing, we do look for retests of those breakout levels as potential future entries. So, if you can't get in on the breakout, but you still like the chart and you still like the company and the stock, then those are levels where you can look to get back in and find another good value entry where your risk reward is worth taking the trade on.
Yeah, absolutely. And so, some of you might be frustrated that we're not really highlighting any opportunities right now that we're willing to buy today, here, now. So we're gonna show you a couple. We're not just gonna highlight the bad price action. Let's focus on some of the sectors that are doing quite well. XLV, we talked about that in the last live stream, the fact that it looked attractive here as it was breaking out above this basing pattern, the moving averages curling up, and you can see XLV is moving up 2.6% today. So this is definitely a sector that's seeing a lot of tailwinds right now, and so we have a few trades that are in parts of the market that are seeing some relative strength, right? So we're not 100% cash. Yes, we do have a short trade on the S&P 500, and yes, we removed all of our exposure to tech, but we're not 100% cash. There are still parts of the market that are actually doing quite well, right? And again, XLV is a good example of that. One of the stocks that's on our watch list right now, and I'm not sure if we initiated a trade, ended up initiating a trade today, but CB is a stock that we may be initiating a trade on today. So if you're a member on the website, you'll get an alert for this. But this is depending on the price action. But it's resuming. Look at the relative strength, right? Very strong price action, slicing through a key trend line. This is a stock, by the way, that came on our watch list thanks to Warren Buffett, that has been accumulating this stock for a while now. I believe that he started accumulating it in mid 24. I believe that's true. You can fact check me on this. I'm not 100% sure. But since then, it's been on our watch list. We never initiated a position on it. And the stock has indeed been just slicing through and just consolidating. But now it seems, for the first time, really, it seems to be finally resuming its uptrend and maybe taking a jab at new all-time highs. And we've looked at this stock from a fundamental standpoint, and it has a tremendous track record at growing its earnings. Right, this is an insurance company that it doesn't have these extreme swings, but it has the benefit of having very, very steady earnings growth, and so that makes it quite interesting today, given the market weakness, given that we're not 100% sure how long this tech correction is going to last. We like these types of stocks that are going to provide us with some opportunities, some returns in this period of volatility. So next stock, also in the healthcare sector, very, very strong price action. This ISRG. This is a surgical robot company that's been thriving for a long time now. So more of a biotech stock, healthcare stock, you could argue. And this is a stock that's been consolidating since late 2024, and it is finally resuming out here above a downtrend that it started in January of 25. And depending on the price action, we're really looking for a breakout here. But that would potentially set off a much larger move up on this stock. So again, I'm talking about lots of trade ideas here that are potentially getting ready to get added. If you want those alerts, don't miss the Black Friday offer that we are doing. Right, it's next week, a couple weeks from now, we won't that offer won't be there anymore, and so you'll be paying a much larger price for the same service. Right, so if you're interested in having these types of trades, and we provide plenty of education in the weekly videos that we post, don't hesitate to grab that. You can click on the link down below to access it. Let's cover one more stock that's interesting before we dive back into the tech sector and highlight why we don't expect the tech correction to be that deep. But Berkshire Hathaway is looking very interesting today. Lots of relative strength here, emerging out of a basing pattern that it's been building since June of 25. So very much the type of setup that we like. A good example of that would be right here, July of 2024. Big, nice breakout above a basing pattern right here. Big move up on Berkshire Hathaway that moved up 15% during this period, by the way, that where the market was declining. So Berkshire Hathaway is in its own kind of way a defensive stock. It does tend to be correlated to the market, but there are many periods where the market is moving down and Berkshire Hathaway is moving up because of the nature of this stock that is, of course, a holding company that has plenty of cash. We know that Warren Buffett has been accumulating huge cash positions. And so every time the market moves down, the market suspects that Berkshire Hathaway is going to be able to put that cash to work in attractive areas. And so it gets bid up. And that's what's happening right now. And it's done a nice breakout. It's retested. And depending on the price action, we may be entering this trade. We may also be entering this trade today. And yes, okay. So yeah, I don't know if you wanted to add something on this, Nick.
No, that these are all stocks like you had alluded to that were we haven't entered them yet, but it would be likely after this live session that at least with Berkshire and with CB, that those are trades that we're looking to initiate today. And again, to reiterate the point, is these are stocks in sectors that have a current tailwind behind them. We're not looking to get into a stock like an AI stock right now that's currently on the way down and trying to bounce. We're looking for stocks that have strength behind them, that
Yep.
aren't necessarily correlated to the drawdown that we're seeing right now in the market. But we're looking for positions in areas that are propping up the market. And that's just a little bit into our mindset and our trading style, where we can stay allocated while the market is pulling back, and still realize gains while the market is necessarily or not necessarily moving.
Yeah, absolutely. And that, by the way, is leads us nicely onto the next section, where I wanted to answer another question that I saw in the live stream on Wednesday. Was, is it worth being a retail trader when there's these institutions out there that are spending hundreds of millions of dollars in order to outperform the market? Can you actually beat the market? Is it even possible to beat the market as a retail trader? And first of all, well, the simple answer is absolutely, and it's a myth. It's a complete myth that institutions necessarily outperform the market. There's the hedge funds, financial institutions have so many disadvantages compared to a retail investor in terms of achieving a particular performance, right? Um, so when a good example of that is, if you're a hedge fund and you have a $20 million position, right? Can you put a stop loss on a $20 million position? How much slippage are you going to get on that, right? How much is that going to move the market? How much are you going to make that particular stock move if you're trying to dump $20 million of that stock in one go, right? That's that's just not something you can do, and that's why a lot of most hedge funds don't have stop losses, and that's something as retail investors that we happen to think that stop losses are one of the most important things that can allow us to generate returns and beat the market. And it's not something that we would be able to do if we were managing hundreds of millions of dollars, right? So in that sense, there's already just a mechanical uh, potential for outperformance. But also, as I mentioned earlier, as a retail investor, you have so much more liberty, so much more freedom to do what you want to do, right? As a hedge fund, you can't go almost 100% cash and short the market uh, just because you are a little bit worried that there's vulnerability, and that you have the flexibility to just get back into the market when things get better. That's not something that you can do with most hedge funds. There's compliances, there's boards that we you have decision making that involves many people. Um, so it's something that we do very frequently, is shift our allocation completely just because we're seeing something that we believe is risky, or that we believe is an opportunity, and we really double down on those parts of the market. And that's also why we have sometimes some variations in our performance, right? It's not a perfectly straight equity curve where we're diversified to the bone, right? We have sometimes we're gonna bet big on certain things, right? Because if we see a big opportunity, why not make the most of it, right? If we see an opportunity that we think can generate a significant return in the market, we're gonna bet on it. And so that's why we have a weighting system on the website. Um, with where we actually highlight what type of allocation we would give to each trade. um, and when we have a higher conviction, when we believe the price action is strong, we're going to put a higher weight on that trade. When we have a lower conviction, we'll trim off some of that position, we'll reduce our risk. And so that's a big part of being a retail investor, being an outperformer in the retail space, is to be able to have that freedom. And by the way, that's something that I mentioned that briefly earlier, but it's something that we're already seeing on the website to some degree. when we send out an alert on a trade, um, especially on trades that are with on smaller capitalization stocks, we'll see the market move, right? And then we'll get complaints from clients saying, hey, 5 minutes after the 10 minutes after the alert was sent, the stock was already up 3%. I wasn't able to get in at the price that you put on the alert. And that's slippage, right? That's what the hedge funds experience. We experience it to some degree, and that's why we've already restricted the universe of stocks. We've completely eliminated small cap stocks, very small cap stocks that don't have much volume. We've removed those, and we're focusing on mid cap, large cap. But that's one of the things that, again, restricting your universe of stocks because you have other people, more capital involved in those trades. And that's first of all, that's one of the reasons for why we increased the baseline price of our membership consistently over the last few years. Because if the price is too cheap, there's too many people coming on, too many people jumping into these trades at once, and ultimately it can't work, right? That's unfortunately that's how trading works. You can't have everybody knowing the right trades, because everybody's going to get in on them, and the price is not going to be the same anymore. And so we'll probably continue raising the price, but ultimately we might even need to completely close the access to our current strategy and launch a separate strategy with different trades, with a different trading team, which is, by the way, the way hedge funds work, right? A particular strategy generates a lot of interest, a lot of capital it attracts a lot of capital, it works, and then all of a sudden there's too much capital, the strategy needs to be restricted, closed, and you have a new trading desk that opens on the hedge fund. That's how these hedge funds, at least the high performing hedge funds, grow. So yeah, retail traders, just to cut a long story short, retail traders can absolutely outperform, and there's many reasons to believe that retail traders actually have an edge on institutions rather than the opposite, which I'm not 100% sure why people suspect that institutions necessarily have an edge. It's fairly obvious that they don't. Apart from, of course, the lack of knowledge and the lack of discipline that a lot of retail traders have. So if you have the knowledge, you have the right edge, and you have the right discipline and the right approach, then you can outperform the market. Obviously, if you're coming in as a retail trader and you don't know what you're doing, you don't know how to manage your risk, you don't know how to read what the market is telling you, you don't have a systematic approach to selecting your trades, you're going to get crushed, right? That's why 90% of retail traders fail. But if you're willing to put in the work, you can, right? You can outperform. And again, this is something that's going to be covered extensively in the curriculum. I just saw a comment asking when these episodes on the curriculum are going to be made. There's 2 that have been made, right? And we're going to be releasing and we're going to be filming another one next week. So that's going to be released probably 2 weeks from now, and we're doing our best to deliver that as quickly as possible. We did want to give you guys a chance to actually get this at a reasonable price during Black Friday before we release this out for the default pricing. That's going to be more expensive. So finally, let's. I don't know if you wanted to add anything else, Nick, on that topic of retail traders.
Other than the point that you had made, where with the right strategy and the right discipline, you definitely can outperform retail or institutional investors. And one thing that a lot of people are of the mindset is that they have access to different information and different resources. And while a part of that is true, there is enough information out there that institutional investors track that you have access to. I mean, we're living in a world right now where we have access to a lot of information, and it's just about trying to figure out which information is the most pertinent and how to use that information. And that's a lot of the stuff that we try to cover in our course curriculum is, finding what information is useful, and what exactly is kind of something that's not really related to trading. So
Yeah,
other than that, I think you made a very good point there.
yeah, yeah, absolutely. Um, okay, let's move on to the final part of this live that I think is the part that is most interesting to a lot of people, is whether we're going to see a complete decimation of the AI trade today. Now, we talked about the fact that semiconductor stocks were benefiting from this AI theme massively, with real earnings growth, right? It's not a bubble in the sense that these companies are growing their earnings. The innovation AI stocks are definitely, um, most definitely in a bubble, but these semiconductor stocks are just benefiting from that. That being said, they're interconnected in a big way. And as we mentioned at the beginning, if a Palantir, for example, um, begins to drop like a stone here, and Tesla as well, and you start to see the valuations of even the private companies come into question, the OpenAI and Anthropic and all of those that have been raising massive amounts of capital. If that begins to unwind, that does potentially translate into a real risk for even Nvidia, right? Nvidia just reported earnings. They beat earnings like they always do, um, and they beat expectations. But if you start to see all of these AI innovation companies start to decline, then is that going to start to impact the way analysts expect NVIDIA to perform? Is that going to impact NVIDIA's future earnings? Very possibly, right? So it's NVIDIA has had a very easy time in this environment where everything's been rising, and Palantir has gone up to a PE of 400. OpenAI is now almost a $1 trillion company. Massive amounts of capital driving massive amounts of demand for semiconductors and data centers. But if even a 50% correction could put some of that extreme earnings growth into question. So there is a risk, right? And I don't want to understate that. That being said, when you look at history, um, asset bubbles, tend to be popped by the Fed, right? And there's a very strong track record to actually show that. You had the housing bubble in 2005. Let's see if I can add the price of homes here that were melting up here. Very, very strong housing market. And then look at what the Fed does. They raise interest rates. The housing market stops to rise so aggressively, and it starts to roll over. So the Fed pops the housing bubble, right? Let's take a look at the tech sector that was in a bubble in the late 1990s. Tech sector melts up, melts up, melts up as the Fed is generally lowering interest rates throughout the late 1990s. And then late 1999, early 2000, the Fed raises rates to the highest levels in a decade, and it pops the bubble, right? We can go back further If I can find the 3-month yield, we can go to 1929. If I can find the data on it, it's not always the easiest to actually find. There you go. I can find it there. So this is essentially the Fed funds rate in the 1920s. And of course, the stock market, not just the tech sector, not just not just a particular sector of the market. The entire stock market was a bubble in the 1920s, and you can see very similar to that 1990s example. You generally had the Fed that was lowering interest rates during that period. So the price of money, borrowing costs were coming down in the 1920s, sorry. And then the Fed started to raise rates in response to the excessive speculative behavior that was clearly present on the stock market in 1928. That popped the bubble, and ultimately, it precipitated, let's say, the Great Depression. Now, you can argue that the Great Depression was also due to a lack of enough monetary policy response and a lack of government response. There was a lot of deflation in the 1930s, and yet the rate was still positive, right? The interest rate was still positive, which means that accounting for the deflationary conditions, the fact that interest rates were still positive means that real interest rates were very, very high in the 1930s, which was very restrictive. So even in the middle of the Great Depression, the Fed was essentially had a very tight monetary policy adjusted for inflation. And that probably deepened the Great Depression to a large extent. Not necessarily something that I would expect this time around. A lot of people are very concerned about a Great Depression. We certainly can have a lot of financial pain in today's modern monetary system. Lots of leverage, lots of debt. But we do have institutions, especially the Fed, that was quite young back then, that has learned from its mistakes, hopefully, has learned from its mistakes and would be a lot more ready to supply enough liquidity, lower rates enough in that kind of deflationary scenario. And we certainly saw them do that during the pandemic, where they flooded the system with liquidity. They printed huge amounts of money. The real risk in that type of event, and I'm getting a little bit off track here, but the real risk in that type of event is that if the market collapses, a real recession happens, we go into some kind of a deflationary environment, just like during the pandemic, that the Fed is forced to flood the system with liquidity again, do quantitative easing, and the government needs to spend in order to revive the economy, and that creates a lot of debt, right? It creates another wave of inflation, just like we saw after COVID, and the combination of the inflation and the high levels of debt could create some kind of a government debt crisis, much higher interest rates, which would lead to potentially a secular period of stagnation in terms of economic growth, and also probably financial markets. So that's the real risk today. But as of now, is the Fed trying to pop the bubble? Well, it's about as simple as this, right? And it goes back to this old saying: "Don't fight the Fed." The Fed is lowering interest rates, and they have to, right? They have to, because the unemployment rate the unemployment number that we got yesterday is showing that the real economy is still struggling. We have unemployment at 4.4% now. That's rising unemployment. The Fed needs to respond to that, right? And it doesn't matter what how hot AI stocks get, but the Fed needs to cut. And so this is a macro setup that's quite concerning, by the way, because you have a setup where the Fed needs to cut to revive the real economy. The real economy is stagnating. There's no doubt about it. But you have a financial system and the tech sector, especially, that's hot, red hot, but through more stimulation of the real economy, it could lead to much more excessive speculative behavior on the technology sector and on the AI plays. So that's why we do not think that this run is over on tech stocks. Whether we've already seen the bottom or whether there's more pain to come, that's another question. But yes, this is definitely a setup that we think can ultimately resolve higher.
And that's why at the end of the day, we're going to be looking at the price action, and if what we're seeing in the macro environment continues to indicate, all systems go with regards to monetary policy and unemployment and inflation, then when constructive price action set up, we're going to be looking to not only go long, but go long in those sectors like the AI sector, like semiconductors, that are going to show relative strength in that environment. And yeah, it's important to concentrate your capital in the best playing out there, in the best playing sectors. So that's what we'll continue to look to do.
Yep, absolutely. Final thing that I wanted to touch on, because we did see a few comments also talking about the curriculum and exactly what the curriculum is going to look like. And so I did want to give a brief overview of the structure of the curriculum. That's going to be divided into 5 different modules, or 6 different modules. Sorry, I should say 6. First of all, we have the timeless principles that I think, we wanted to start off with timeless principles because these are really the things that make or break traders. It's the essential foundation that if you don't understand these timeless principles, you'll never is a big word, but it's very unlikely that you'll be able to outperform. So we wanted to really set that clearly, and that essentially applies to any trading strategy, right? So these are principles that you can apply to regardless of what type of trading style you have. These will be relevant. Then we go into our own trading system, our own trading strategy that we've been developing for. Well, I've been trading for 10 years now, so I could say it's been in the makings for 10 years. The module 2 is essentially going to be a broad overview of what the trading system is and an explanation of our trading strategy, very broadly, a summary of it. And then the other 4 modules are going to be essentially diving into the details of that system. So how to scan and select trades that outperform, how we select those, looking at different sectors that we want to be exposed to, the setups from a chart standpoint that we want to be exposed to, how we manage those trades, right? So entering at the right moment, making sure that we're entering at a moment that is timely, right? And that has the highest odds of leading to upside in the near term or downside if you're shorting. Setting the stop loss and also knowing when to take profits, right? Understanding when a stock is waning in momentum, when it's not behaving in a way that is constructive, and you want to be reducing your position on that. Thirdly, how to time the stock market, right? So what I discussed at the beginning of this video, um, in mid October, we started to see real uh, real warning signs, real deterioration in the market's behavior. And that prompted us to get more defensive and much more cautious and go pretty much 80, 90% cash, and even more recently short the market, right? So how do we do that, right? We use tools, we analyze, we prioritize certain things, right? And certain observations, and this is a big this is going to be a big part of that module where we highlight all of those tools and try and give you a much of a as straightforward of an answer as possible on how you can actually do that yourself. And then finally, the sixth module is additional edges. So a lot of the first modules are going to be around, very basic, the basic foundational principles of what makes our strategy uh, successful in the market. But on top of that, there are many tools in terms of sentiment, positioning, intermarket analysis, macro analysis that can help you increase your edge. It increases your conviction level. It tells you, okay, if all of these things are aligned, I can make this a 15% of my portfolio because I'm very convinced that this is going to be a trade that actually plays out. Of course, you still manage your risk and you still adapt based on weak price action, but these additional edges that you can add on top of your initial baseline strategy can increase not only your potential returns but your win rate. So again, you can hopefully this provides a more clear view of what that curriculum is. And again, this is a big investment, right? Um, we're going to do everything that we can to make sure that this is worth it, and that it actually teaches you the skills to be profitable in the market and to generate higher returns. That's ultimately the goal of this curriculum. But yes, it is a big price tag, and hopefully you'll have time to use the discount that we're doing right now to take advantage of it. So yeah, I think that was about all that we had. I don't know if you had other things to highlight, Nick.
That's everything on my end as well. I just with regards to the curriculum, there's been a lot of time and thought in breaking down each different section and going through with the different clients where what the most important things that they've been needing to go and improve their own trading, and it's allowed for a lot of reflection on our own trading strategy. So there has been a lot of time and thought into being put into this, and um, I think especially for newer traders and traders who are looking to improve their skills, this is well worth the investment. Just because it's gonna help you skip a lot of the initial pain that a lot of newer investors have to deal with. A lot of um, the loss equity that they're going to have to go and suffer through before they kind of build their strategy. So yeah, just there's been a lot of time and effort being put into into this curriculum, and we think that'll be very useful for a lot of you guys.
Yeah, absolutely, absolutely. Okay, yeah, I thank you again, each and every one of you that joined the live, and also uh, the ones that are joining afterwards, and just generally everybody that's following us on YouTube. We would not be here without you. We very, very much appreciate that you guys are here, that you guys are listening to what we're saying. It's amazing, and we love what we do, and yeah, it's great. Thank you.
Yeah, thanks, guys. Appreciate everything.